Hi everyone. Today we're going to be looking at accruals. We're going to be understanding what the accruals or matching concept is, and we're going to be understanding what accruals essentially are. So the accruals or matching concept is a fundamental one. It essentially means that you record revenue, income, expenses, or P&L items in the period they relate to. So we don't care about when cash was moved or paid or received, and we don't care about invoice date. Okay, so don't consider those two things. The accruals are, the way to think about it is if I have a purchase invoice received after the year end, but it relates to before the year end. I need to record an additional expense before the year end, right? How do I do that? Well, I do debit expense, but where does my credit go to? Well, if I'm not moving any cash, it's going to go to a liability account. So it means we owe money. And we call this liability account the accruals account. Okay, so it's a balance sheet account, not a P&L account. Now, I need to use an example to explain this a bit more. So we have a company preparing year-end accounts for this date. A gas bill came through after the year end for £700 for this period. Okay, so we know the invoice relates to this 7-month period. How do we treat this at 21? Well, firstly, I'm going to draw my timeline, and I'm going to show you that the invoice straddles the year end. So we have 30th of April 22. Our year end is 31st of December 21. Okay, that gives me 4 months difference, and the remaining 3 months we put here, and then we have 30th of September 21. Okay, now what's the significance of this? Well, it means we need to record an additional expense in this period where I'm drawing the cloud. So if I have my 7 months, 7 months is going to be the same as £700. So what is 3 months going to be the same as? Well, it's going to be the same as 3/7 of £700, and that's the same as £300. So we need to increase our expense by £300. And how do we do this? Well, we do debit expense £300, and we put the credit to accruals, as we stated before, of £300. Don't you just like it when everything ties in? And then that's us done, and we can go to sleep. Now, if you think about it, so the 3 months corresponded to £300. Let's see, what does the 4 months here correspond to? Well, it corresponds to £400. Okay, so this time we're going to be looking at the same example, but what happens for 22 when the invoice actually came through. Well, let's see what expense we actually expect to get for 22. As I said, 3 months is the same as £300, so 4 months is going to be the same as £400. So my expected expense is £400. Now, okay, so the accrual was only relevant for last year, and we therefore need to reverse it. So we do debit accrual X and credit expense X. So I'm just going to put my accrual here, or put the accrual this way, and we're going to put the 300 this way. But as you can see, this is a minus 300. It looks like we just generated income out of nothing, but let's see how we correct for this. So the invoice came through in 22, so we need to put through the full invoice amount for 22. So we do debit debit expense 700, and we put the credit to trade payables. Now look what happens. So I have minus 300, I'm adding on 700. What do I get? I get 400. So as you can see, it all worked out in the end, because my expense I'm getting is 400 and my expected expense was 400. So it all worked out in the end, and they all got married. So just to summarize, accrual is a liability and expense. We record it by doing debit expense, credit accrual. We reverse it by doing the opposite, and record the full of invoice amount by doing debit expense and credit trade payables. Okay, so that's us done, and email me if you have any further questions.